How's it going, everyone? It's Sam. I want to talk to you today about two companies kind of that are very tightly related, pretty much the same company, that Bill Ackman thinks could go from about $2.70 and pretty much 6x from where it is now. So it could go between $10 and $15 a share pretty soon. So he was asked which of his companies is his favorite one, and this he puts in a little bit higher risk category, but it is a really interesting company. It's one, or they both are probably companies that you've heard of, but have not looked into for investing. And I'll play the video first of all, him talking about the company. And this video is from Interactive Investor on YouTube. Definitely check him out if you haven't done that already. He seems like he's a really smart guy. He has interviewed a lot of smart people. So if you want to check out that video originally, you can check it out. But I'll play it here in a second. And then I'm just going to run through where the stock is, some analyst expectations, what's happening with their revenue and their net income, because it's kind of impressive, and then talk to you about what's going to go on going forward and what I'm doing. So if you guys like this, please leave a thumbs up. I really appreciate it. Also, please hit subscribe if you haven't already hit subscribe. I really appreciate that. And this is the last day, if you're seeing this Monday, to get 4 free stocks through WeBull. Definitely check out the link down below. If you deposit $100, you get 4 free stocks. And there's a link down to Patreon where you can hear about stocks right when I buy them or sell them. So definitely check that out too. We're over 1,000 investors on that right now. So definitely check that out. So I'll roll the video for you right here.
Hello, today I have with me Bill Ackman, one of the world's best-known investors and the man behind hedge fund Pershing Square Holdings. Hello, Bill. Thanks for joining me.
Thanks for having me.
You've already said that you own 10 companies that you want to invest in businesses that you're going to own for a number of years into the future. So, but my question is, amongst those 10, is there a favourite stock for 2021? Is there one that you think, well, I really think this one will do better than the rest in 2021? And also, or is there a particular sector that you think investors should be looking at for the next 12 months?
So, we like all of our companies, which is why we own them. Obviously, if we didn't like them and didn't think they offered attractive risk rewards at this level, we would sell them. There's one I think that's a really interesting special situation. It meets all the same criteria for business quality, but it's a much smaller investment in the portfolio, and I think it's worth a look. So Fannie Mae and Freddie Mac are pretty well-known companies globally, and they're also well-known for blowing up in the financial crisis. Fannie and Freddie, their business is basically buying up mortgages from banks, kind of what are called conforming mortgages that meet certain standards, or mortgages on middle-class people's homes. And they, chop those mortgages, they put them chop them up into little pieces, in effect, by issuing securities backed by them, and they guarantee those securities. So it's a insurer, if you will, of very, very low risk assets, and it's how the U.S. housing finance system works. We have a 30-year prepayable fixed rate mortgage because Fannie Mae and Freddie Mac, beginning as early as the 1930s, were in that business. They blew up during the financial crisis because they were inadequately capitalized, and they started buying subprime and other securities, and it wasn't adequate oversight. We 7 years ago bought into Fannie and Freddie on the belief, the government ended up taking them over, putting them into what was called conservatorship, and then injecting a large amount of capital. And people believed that Fannie and Freddie would never be able to pay back the government, and they were, in effect, insolvent. The reality is they recovered very, very quickly from the financial crisis, and they repaid the government with the 10% interest and more over time. But for political reasons, the Obama administration stepped in and said, well, even though you paid us back, we're going to consider our obligation not paid back at all. And so the stocks languished in the kind of low $2 a share range. President Trump and the Secretary of Treasury, Steve Mnuchin, basically said, look, this is not a tenable situation. These entities need to go back, they need to be recapitalized, they need to go back to the public markets. And he began a series of steps early in the Trump administration. And almost all those steps have been taken. The most recent step was the issuance of a capital rule, which says that these entities are going to have to hold something like $280 billion of capital. and today they have, call it 30 billion of capital. On December 9th, the Supreme Court is hearing a case as to whether the government's expropriation of these companies was legal. So that's a really interesting, you'll get some interesting data on how the Supreme Court feels about it. It's a more conservative court now because of recent appointments. Conservative courts don't like expropriation of private companies, so there's a big opportunity there. And then it's the last 2 months of the Trump administration. Mnuchin, we think, will want to finish the job. If either of those two outcomes happens in a favorable way, this what is today a $2.50 stock could be a $10 stock in a very, very short order. And even Biden, if neither of those two things happen, the Supreme Court does not rule in favor, and Mnuchin is too distracted by other things in the Trump White House to do anything, we still think that the next administration will continue on the path of bringing these companies back to the public market. So it's sort of an interesting special situation with a very attractive risk reward, trading, maybe something slightly above our cost 7 years ago. So it's an investment that has not panned out yet. And as I say, we're super long term, but it's the only thing in the portfolio that could be up 4, 5, 6x in the next 12 months. So that's the more exciting part of the portfolio. Actually, the head of the I heard he passed away recently. When I described that situation to the head of the Wellcome Trust, the CIO, he said, "Oh, is that the sex and violence part of the portfolio?" I said, "Well, it's an interesting way to describe it." So.
Well, it's fascinating stuff, Bill, and we'll watch that one closely. Bill Ackman, Pershing Square Holdings. Thanks very much for joining me today.
Thank you so much. Appreciate it.
So just taking a look at both of these companies here, they weren't listed exactly their ticker symbols. So both of these are on the OTC markets. You're going to have to search around for an app that will actually allow you to trade these. For example, I use Fidelity for OTC stocks, but the first one is FMCC, and that's Freddie Mac. That company has gone up from $1.74 to about $2.71 over the last month. The other one is Fannie Mae. It's FNMA. And this has gone from $1.84 and it's gone up about 50%. Now, if you take a look at both of these side by side, it's really interesting how they are the exact same shape. So I don't know exactly why this is the case. They are traded under two different ticker symbols, but every single day is the exact same. They're just at different price points, which is interesting. But first of all, let's take a look at FNMA. So they have an analyst expectation. On the low side is about $3. On the high side, it's about $7.75. So this represents a pretty big boost from where it is now. On the high side now, they say that the average represents about 7.53% increase. And again, this is FNMA, which is Fannie Mae. The other company is Freddie Mac, and that one is representing an upside of about 46%. So they have a median target of $4 and a high estimate of $7. That's about 46% upside. Now, looking at both of their companies just on Seeking Alpha, you might be a little bit confused. So this is FNMA. Again, I'll tell you what I'm going to do with this in a second, but this is a pretty small company overall, and they have net income of about $11.6 billion. Now, again, just looking at FNMA, I saw a couple different numbers. So this says $3.19 billion. On here, I believe it said $16 billion. But either way, the net income is crazy right now. I mean, they have really high revenue. First of all, it's about $22.6 billion over the trailing 12 months. And they have about half of that in net income. The thing is, they have a large amount of preferred dividends and other adjustments, almost exactly what they actually made in net income. You can see that pretty much every quarter, and it's weird because it fluctuates, right? Then you go over to Freddie Mac, and they have something very similar. It's the same kind of weird up and down with their net income. And then when you look at net income afterwards, what's actually paid out to shareholders, a lot of the time it's negative or it's right around zero, or, it's kind of interesting. But the reason for this is what they talked about in the video. These companies have been paying back the U.S. government for their bailout for a long time. In 2008, they had a $190 billion government bailout. And since then, they've sent back over $300 billion in the form of dividends to the U.S. Treasury. The U.S. Treasury is making bank on this. Now, They are talking about possibly bringing back a dividend. So if they're able to get out from under this, they are considering paying a dividend. They do have a very high net income. When you consider just $12 billion or even $7 billion, just looking at what the dividend could pay, it's hard to tell exactly, but it would be very significant. It would be a very high dividend payer, or they would just have a lower payout ratio. But either way, I think it has a lot of potential upside. Now, they are expecting, at least in this article, that they will see some newly issued shares just to move the process along to be able to raise some capital. They are expecting some different kinds of stocks. They have issued these types of preferred stocks in the past with high dividend yields. So this is something to keep on your radar. Now, I am not buying these right now, but again, like they said in the video, December 9, they started talking with the Supreme Court on what's happening, whether they're going to be able to get out from under this or whether they're going to go private or stay public or anything like that. I mean, there's a lot going on with these companies, and I'll be honest, part of the reason I'm not investing in these is because I don't fully understand the business. I mean, when you get into these mortgage loan companies, it gets kind of confusing. Put this one on your radar. I'm going to be keeping this in the back of my mind and checking up on the Supreme Court proceedings and seeing where this goes, because it does have a lot of potential. Bill Ackman says that he thinks it has a lot of potential. It is interesting. It would be a high dividend payer, I believe, if they're able to not have to pay, $7 to $12 billion worth of their net income over to the government. So keep this one on your radar. Let me know what you're doing with it. I appreciate it. Again, if you want to see some other stocks that I've been looking at, you can check out this video from earlier. I did a video on SPAC stocks that are around $10 a share, so definitely check it out. They kind of limit your downside. I'll put it on the end screen. Also check out WeBull and Patreon down below if you want, and hit the like button. I really appreciate that. We are growing to 50,000 subscribers, so if you don't mind hitting that subscribe button, really appreciate that too. I know I'm asking a lot, but it is the holidays, so if you feel like giving, you can definitely give by hitting the like button or the subscribe button. Thank you guys, and here's the video on those SPACs.